Okay. Yeah, thank you. Thank you for inviting me, and then thank you for for having me. Yeah, I met Maurice from Anoma actually, I think 3 weeks back at Interopolis, which was an interop community-focused meetup and working group event, and in Athens, and there were a lot of discussions amongst the interop community. And yeah, I'm part of Sprinter, and we are actually building solver infrastructure, operating solvers, and there was also a track on solver economics back there at Interopolis. And our perception was a little bit that there's kind of some, I would say, misconceptions about solver economics and the state of competition in solver-based networks. Yeah, so I thought, or we thought it's a good thing to share a bit more about that, about where we are and how we see the current state of competition in solver-based networks. So yeah, there we go. Yeah, I think the presentation would be roughly 15 minutes or something, and then we would have plenty of time to answer any questions or discuss some of the issues brought up. So yeah, I really hope that that this will be great. Yeah, I will start with a short history of Sprinter. As I mentioned already, we are focused on solver infrastructure, operating solvers for a bunch of protocols like CowSwap, Across, Mayan, and some others. We actually have been or have our roots mostly in the interoperability space. That means we started actually out with building cross-chain bridges. I think probably one of the first general message passing based cross-chain bridges was built by our team back in ChainSafe, and I think 2020 or something. We then later on made it through all the layers, did cross-chain verification on the CK side, did optimistic bridges and beyond, but then also got infected through not only Anoma, but also others, obviously, with like the intense type paradigm, I would say, solver-based networks and stuff like this, and switched then to solving, I think, in late 23, early 24, and it's now our main focus. We also then last year joined forces with another team called Project Blank that focused on MEV searching and solving. We will come to that in a little bit, why that's helpful, and also market making expertise. And now, I think we are a well-versed team around all the things solving. I will start with a little bit with some laying some groundwork where I think probably a lot of things might be familiar for you, but nevertheless, I think it's worth mentioning that. So when we talk about solvers, because not everybody knows what a solver is, we mean essentially off-chain agents. It means mostly autonomous programs that actually fulfill user intents. That means usually search for the best execution of an intent that the user has and bring it actually on chain. Today, I mean, right now, this is mostly swaps. This is mostly cross-chain transfers for solver-based protocols, but we already are seeing what, let's say, more complex intents coming that involve execution at the end, or even other parts across different blockchains. Yeah, solvers are part of the trade supply chain or transaction supply chain. So here in a very simple example, you can see the solver that basically comes into play after the protocol, in this case, a decentralized exchange, auctions off a trade, and then solvers compete to be able to fulfill that trade. In that sense, solvers act as a kind of market of optimization. And that's kind of an important point that we want to make here. And that's, from our perspective, when you look at it probably as an economic person, things like why do we introduce the solvers? It's basically for the user very hard to on its own to keep, I would say, keep an overview and oversight over all the potential avenues on where he could, for example, execute the swap. And where's the best way? Where do I get the best price? And stuff like this. So kind of to build this economic trust, the DEX protocol, for example, in this case, when it's about a swap, starts to delegate this, building this economic trust to a market of solvers that compete then to basically provide a fair outcome for the user. So we will see and go next to into a bit how this competition looks like, and also see that maybe the assumption that these are fair markets is not really given, at least not right now. Okay. Here we want to we are coming basically, I mentioned this already, from the cross-chain side on one side, and then on the AMM or searcher side, this is the other part of our team. Generally, when we look at solving, and right now I mentioned this already, we look mostly at two types of solves. One is swap type solves. The other one is cross-chain solves. It means bridging in the most case. We already see also combinations of that, but I want to highlight with this slide a little bit that it's kind of very different in terms of the skill set that you need, in terms of the process steps that are taken on how a bridge swap looks like versus how a swap solve specifically with AMM liquidity, that means with on-chain liquidity, looks like. But let's first look at the, maybe 5 steps that you can see, process steps that are in the boxes. And then let's talk a little bit about the differences between a swap solve and a cross-chain solve in regards to them. So first step would be, sourcing liquidity. So most, and that's also maybe worth mentioning, all the intents and trades that we fill right now are usually asset-based. That means there's liquidity involved, and that's either a swap, in most cases, a cross-chain bridge or a cross-chain swap. And that means in the first step, we as a solver, we have to understand what liquidity exists and also at what costs. And this means we have to find, hey, what is the available liquidity sources that the solver can use? So this might be on-chain pools in Uniswap or whatever. This might be RFQ endpoints. That means like liquidity that is available basically off-chain to us. This might be an internal inventory. So a lot of solvers have own inventory available to them in smart contracts that can be used and stuff like this. Also, this includes not only understanding where the liquidity is, but also price impact curve. So that means how much will the price be impacted if I, for example, take 1,000 USDC out of that pool versus 10K USDC out of that pool. Another important aspect on the liquidity sources side is fee structures. That means we have to understand how much gas would we pay to access that liquidity. What is eventual protocol fees? So most, for example, on-chain AMM-based DEXs have a protocol fee that is split to the LP and to the protocol, and we have to kind of obviously include that in our cost calculations in terms of, hey, does it make sense to include and use that liquidity source? Okay, so that's for the first step. So we now know, hey, this is the available liquidity that we can use. Second step would then be to optimize routes, and this means specifically that this is more relevant than to the swap solves than it is to cross-chain solves. That's why you see the indicated kind of dots here on the two different solves. And that means actually we have to kind of find a way, can we optimize our trade path? I already mentioned that, for example, in AMM-based DEX, there's always a price impact depending on the amount you swap and stuff like this. So that's why you would, as a solver, usually start to optimize your trading paths. That means you would split, for example, doing multi-hop swaps. That means when you want to, for example, trade ETH to USDC, you would maybe not necessarily go directly from ETH to USDC, but have a certain amount, up to 5, 6, 7 intermediate tokens that make you swap via other pools to minimize the price impact or the slippage impact. And also this might be multi-venue. That means like, hey, even if I want to swap USDC for ETH, for example, I might actually want to split a big trade across multiple venues. That means going to Uniswap V2, Uniswap V3, Balancer, all in parallel. So in order to have smaller batches simply with a smaller price impact in total. So you can look at this. There are some providers, I think, for example, Odos, that have a pretty neat web app where you can actually see how routing for a swap would look like in real time. It's actually pretty exciting and to see how sophisticated AMM routing is nowadays. Okay, so we now have we have actually optimized. We have our routes. The third step is then risk management. So we have to decide then as a solver also, do we want to actually take that risk to actually bid on that trade? Because on the trade has usually a potential upside for us. That means a certain fee that we can collect, and then we have to decide based on the routes that we have available where we could execute, do we want to actually do that? Because usually there's a small delay between like us bidding and then us executing the solution. And that means in this delay, which is the inclusion delay, the price actually can have moved against us. So when we have, for example, some paths created and calculated, and there is some long tail assets, we call them. That means assets with a very low volume, trade volume and liquidity in those paths. Then there's a very high likelihood that the price actually has moved against us in the time between where we collected and created that path, where we bid and won the auction, and then where we have to settle the solution. So that has to be evaluated, because especially in protocols where there is penalties for basically winning an auction and then providing a solution and settling a solution that actually doesn't execute because the market price has, for example, moved against us and the slippage is too high. So yeah, volatile tokens are in general the biggest thing to consider here. So that's step 3. Step 4 would be then to settle on chain. So we have won the auction. We need then obviously to provide a solution, which is usually then basically a contract and call data that has to be called. And that's then settling the solution. There's a separate step settlement mentioned here that is more relevant in the cross-chain case, because in the case of a swap, then settlement, it means when is actually the point in time where the money changes basically hands, where basically the buyer and the seller exchange the funds. This is happening in the swap case at the same time with on-chain execution. But in the case of cross-chain, that's actually 2 different times, because there's usually an escrow involved. So when you have a cross-chain protocol, then usually the user that wants, for example, to bridge from Ethereum to Arbitrum deposits the funds in an escrow on the source chain. Then we, as a solver, we execute the desired intent. It means like moving the funds on Arbitrum to the destination address, and then we get repaid by the protocol at some point from the escrow once it has verified cross-chain that we actually filled that order. So that means that's also a little bit a special situation on the cross-chain side, because we need to, on the cross-chain side, always liquidity available to front, because we will always only be paid back basically with a delay, with a settlement delay. And that also means like, there needs certain forms of optimistic or other types of cross-chain verification need to happen in order to make sure we can get repaid. Okay, so and then, that's also kind of what you can understand here is a little bit like the cross-chain side requires mainly, I would say, interoperability skills, but not so much searching and solution finding and path finding know-how, where the swap solve case, especially the AMM case, it means you operate with on-chain liquidity and not with your own inventory or private liquidity, then that's actually something that requires basically the same skill set as MEV and searcher teams would have back then. That means with understanding in a very timely fashion on where to route certain trades, and also where certain opportunities for arbitrages exist to optimize the surplus for the user, because that's often what most of those protocols score the solutions of the solvers by. Okay, so now we have understand a little bit what those protocols are and how they a little bit differ. This is just a summary slide on the history of solving. Now with Anoma and other intent engines, I think this will we will move up the value chain, and we will see even more complex intents coming. And I think that the TLDR here is that intent or solver based designs are winning, and we will see more of them going forward. So what we want to do now, and what I thought might be a good idea to do, is give a little bit of an overview of the tech stack that we use. So our team is at the moment, I would say on the solving side, I think three teams of roughly 3 to 4 people each. They mostly use Golang, TypeScript, and Solidity. And that's mainly for the reason Golang is our language of choice. TypeScript is often a language that is used in reference implementations of solvers. And Solidity is then any contract and on-chain work that we need, for example, router contracts, or also our shared liquidity layer that is mentioned below is built on Solidity. So usually when we solve for a new protocol, I already mentioned we solve for Across, for Carl, and Mayan, and some others. We start with a reference implementation, we create a POC, and we make it work, but then it will be slowly replaced and customized going forward. That is not only the reason because in most of the protocols you won't be able to compete with the reference implementation, because the best solvers will already have customized their implementation and will have actually have custom bidding logic, custom bribing logic, and also might have dedicated or specific ways of managing their liquidity inventory and stuff like this. Yeah, our solvers are usually co-located with blockchain nodes simply for cost and performance reasons. We currently don't focus very much on latency sensitive fields. That means we don't have issues similar to high frequency trading where we need to look for very low latency or co-location with certain network nodes. And that's just the reason, we choose it. There's definitely protocols where there is competition that is very latency sensitive, especially in protocols that have first come, first serve type of competition. But we just don't focus on those at the moment. That's why, latency sensitivity is at the moment, not a thing for us. Okay. Here maybe a short overview on what is an estimated cost to just run a solving team. We end up here with obviously some stuffing, some IT infrastructure that is needed. We have here a lower and upper bound of 13 to 26 K USD per month to break even, which is the cost basis. Obviously, that's estimated based on our cost as well as costs of a number of teams that we have spoken to, and should just be a representative, obviously. So there might be teams. There's definitely teams or guys operating solvers that are teams out of one individual only, for example. But I think in general, if you want to be competitive, that means you want to end up in the top 3 or top 5 of the solvers in any protocol. That's minimum what you need. Okay, let's look at 2 examples on the solving side. So let's now go a little bit more into the state of solving competition. And we choose 2 protocols that we are solving in for quite a while now, both having launched in 21. Cow and Across are quite mature protocols and are definitely worth a look because they have quite, there have been quite a while of time where solvers have started to specialize and stuff like this. Points worth mentioning might be on them that on Cow, you see like has done a lot of volumes. We look here at the time span from January to April of 25. Cow has done 30 billion in USD in volume over that point in time. That's almost 6x of what Across as a cross-chain bridge has done in the same time. You can also see the numbers behind the volume here in the second row are the revenue fees collected. So the total revenue collected is 2,100 ETH, and 570 ETH of those were handed out to solvers. So you can see roughly a 70 to 30 split of like total revenue versus what has been paid out of those fees to solvers. Across, as mentioned already, 4.6 million in billion USD in volume in 25 up until now. There is no protocol fee in Across right now, and 1.25 million USD have been paid out to solvers or relayers, how they are called in Across. Mode of competition, Cow protocol has a very sophisticated auction system. It's sometimes even for us that we solved there for over 2 years, not easy to understand. For example, when we did get a penalty, why did we get it, and stuff like this. It's very sophisticated. Some aspects of it is it's second price. It's batched to reduce the impact of latency advantages. It's off-chain, and it also has sealed bits. Across on the other side is quite simple. It's first come, first serve. So there's only one contract on the source chain that you have to observe as a solver for any incoming requests for transfers, and then whoever fills the spoke contract of Across on the destination chain first, this will basically win the trade and will get repaid by the protocol. The other solvers that were just slightly too late will revert. Another important understanding is you can see here, Cow is permissioned. That means you have to pay quite high bond amount of, I think at the moment, roughly 750K USD to actually be able to participate. And in Across, it's permissionless. And that's also what you can see here a little bit in the numbers reflected. It means there's only 20 solvers. Only it's still quite a bunch, but there's, compared to the number in Across, there's roughly 4x more solvers participating. All right, let's now look a little bit at trading volume and rewards. So this is Cow. And yeah, what you can see here is from the 28 of total solvers, then yeah, only 12 roughly do more than 1% of the volume. That's the chart on the left side. 3 solvers together have 50% of the volume, and yeah, that looks quite decent. I think it's okay in terms of distribution. There's one solver dominating a little bit with 28% here, I think, but the other ones are not too far off. On the reward side, and that's the side basically what the solvers get paid out, the view looks a little bit different. Of the top 3 solvers, one of them, and actually that's the first solver on volume-wise, captures almost 50% of the rewards. It means way more than the other 2. And yeah, we will come to that a little bit in the second. But yeah, rewards in cow are basically paid out in terms of price improvement. So there is a reference price that other solvers provide. And then depending on how much better your price is than the reference price, this is basically the reward that you get. And this reward is then also split with cow, the protocol 50-50. Okay, so this is how it looks for cow in terms of yeah, volume and rewards distribution. So quite top heavy, and definitely a solver there that yeah, that dominates the other ones. Okay, what you can see here is basically another axis where we include the information on our estimated understanding of the costs required to run a solving team. So what you can see here is basically a green corridor, which we call the survival corridor. That means that's the teams roughly that are breaking even. And then, yeah, you have an area that's more to the left of it, where you're basically in the kind of non-profitable zone, and you have an area more to the top right, where you are basically in the profit zone. What you can see here and here, the discrepancy looks a little bit more or even harder is basically, yeah, that there's the one solver that we already saw that captures 50% of the rewards is very much to the top right, while there's only 3 ones that are kind of in the survival zone, and basically all the others are not profitable. Yeah, didn't I mention here? I didn't mention that. It's basically the rewards paid out on one dimension. I can't see it here. It's basically the left one, or the y-axis, and the x-axis is the ideal reward, is basically the maximum reward that you could have gotten. Basically that's important because, as I mentioned already, cow has penalties. So basically, if you capture 100% of the solutions and auctions that you won, then you would be very much on the y-axis at the 1.0, and actually the top solver here, the light green one, is almost there. But the other ones, you can already see the 3 in the survival zone, they are a little bit below 0.8. That means they only land 70 to 80% of the rewards that they could actually get if they would settle all their auctions that they win successfully. Yeah, one impact here is maybe worth mentioning that yeah, this top solver that we see on the top right is basically using own liquidity via a private RFQ exclusively. So this solver did, yeah, depending on the volume we saw before, roughly like 8.4 billion in volume in 4 months. So that's, yeah, it has to have access to a significant amount of liquidity to actually do that. So it doesn't use any on-chain liquidity in Uniswap or whatever. It just has an RFQ and uses off-chain liquidity to basically fill. That's also the reason why it captures so many or so much, why it's able to capture so much of the solutions and the auctions that are won, because this off-chain and private liquidity that can be accessed via RFQ has very low risk. I mentioned already before when I explained the 2 types of solves, that an AMM solve, when you use on-chain liquidity, there's quite high risk in terms of market volatility and slippage that can occur with AMM-based DEXs. When you have an RFQ, that all doesn't exist. You just have basically an API interface to a large bag of money, basically, that you can access, but there is no risks like slippage or with the market moving against you in that sense that would cause a settlement to fail. Yeah, so there's also like 2 orange solvers here that we can see below that have a very low capture rate, below 20%, and this indicates usually some kind of misconfigurations or stuff like this, because they actually win a decent amount of auctions, but yeah, in most of the cases they are not able to settle them. So they either have, yeah, some errors in, for example, gas calculations or slippage calculations or stuff like this. Yeah, but what we can see at TLDR, like, it's a quite top-heavy quite top-heavy distribution for cow. And for the top solver here, definitely it captures probably 5x of the rewards of the other teams and could sustain actually 4 to 5 teams, while we have only 3 teams in the survival zone. Okay, let's take the other example. Let's take a look at Across. We already mentioned that Across has 4.6 billion in trading volume over this period of time that we are looking at here, the 4 months of the first 4 months of 25. We mentioned 78 solvers were active in that time period. Only 10 of them are doing more than 1%. Also here you see one solver basically does half or more than half of the volume or the revenue and rewards. In the Across case, it's actually even a little bit more special that the solver is operated by the protocol team themselves and meant to be a kind of fallback solver. That means it usually doesn't compete necessarily in terms of pricing or priority fees or try to fill very quickly. Please recall that Across has a first come, first serve option, but it's more meant to kind of be a fallback option so that actually solves are being filled even if nobody else wants to fill them. But obviously, it's kind of a little bit indicative of the pricing function, because the pricing function here is proprietary. So Across basically defines a limit price themselves, and then solvers compete in the first come, first serve auction. Whoever is first to fill below that price wins, even if another one would come later offering a better price for the user. But that basically the solver of the protocol team here has to fill so many or such a large share of the orders themselves already indicates that the pricing is, at least from the solver point of view, in a lot of cases not worth the risk of trying to solve them. On the revenue side, we already mentioned it's 2.5 million in total fees that have been accrued over the first 4 months in 25, and the distribution looks almost evenly, so or almost the same as on the volume side. So most of the volume is captured by the protocol team themselves at the moment. All right, let's take a look also here at our beloved survival band. Also here we can see, and maybe leave it even a little bit out of the observation on the bottom right. So here you can see volume at first in like millions, and then on the y-axis you can see the revenue or the revenue BPS. That means the share of the volume that has actually been paid out in revenue. BPS just indicates it's a 1/100th of a percent. That means 100 BPS means 1%. And here you can see it goes roughly to up to 35 BPS. But most of the fills in Across are usually between 3 and 5 BPS on revenue, depending on the volume. So, and also here you can see, I can't see, the slides are a little bit small, but I think there are 4 solvers here in the survival zone. There is as said, like on the bottom right, the solver that's operated by the team themselves, which still does after some years the majority of volume and rewards. And there's actually one solver that seems to be profitable, and you can see that as green here on, I think, the 500 mark. Here also there's also like an indication of how much liquidity those solvers have available to them. So you can see like the thickness of the point actually indicates how much liquidity they have available to solve. As mentioned already, in the cross-chain case, you always need to front the liquidity for the user. That means you have to have liquidity available as a solver on a bunch of destination chains actually. And you can see here, I think the top solver, like the Risk Labs one on the bottom right, operates with something like 11 million at the moment. And then the second green one, you can see, operates with something like 4 million USD in liquidity. And that drops significantly down to the 4 solvers that are here in the survival band. I think they operate with roughly 500 to 600K in liquidity. That's important here in the cross-chain case also, because what is not factored in, so in the revenue BPS here, we factored in the gas costs that have been paid. and the fees that have been collected from the user side. But what is hard to include here is both the cost of capital, if there's any to the inventory, and the second one is the rebalancing costs. So as mentioned, when I front with my liquidity as a solver, a fill, for example, on Arbitrum, and get paid back on another chain, I have to find a way to actually bring my funds back to the source chain. And that's called rebalancing. And rebalancing costs are assumed to be usually half of 1 BPS. And those costs need to be factored in as well. That also means if I have way more liquidity, I need to rebalance way less. And that means also like the cost of holding my inventory and keeping it balanced across chains is way less. That's why there is a direct relation to kind of cost effectiveness versus your inventory size. Yeah, so that's kind of how those two protocols look like basically. From a competition and also from a distribution, solver distribution point of view. What is kind of clear to observe, and I could have chosen other examples here as well, not only Cow and the Cross. We just choose them because they are very mature. Other ones are way younger in terms of how long they operate, but there is some tendencies that we can see everywhere. And that means at first winner takes all. So that means there's usually one or two dominating solvers that take at least half of the volume and half of the rewards. Then also most solvers aren't profitable. So solving at the moment, definitely, at least if you want to operate in an area where you belong on to the top 5, then that's definitely at the moment very hard to do. And solving is at the moment actually mostly a reputation game. That means a solver in for example, Cow or Cross will more like use the reputation from being a solver and having, for example, great pathfinding or routing, and use that then to create other business opportunities. We will speak about in a second. There is lucrative day one support opportunities though. So usually when a new chain launches, they will have an incentive program for solvers to provide day one support for solving on their network. And those ones are usually lucrative because of token incentives or whatever. But what I think the main point here is that long-term or mid-term, all those solver-based competition markets that we see don't seem to be that sustainable. So I mentioned that that's why solvers already try to increase revenue by actually moving or doing other stuff as well. So they either focus on their own solver infra to make it and solving more cost effective. That's also why we, for example, introduced a shared liquidity layer that, for example, reduces our costs of inventory management and stuff like this to make solving more cost effective. And another issue is private order flow. That means if you are a top solver in one of the protocols, you will usually try to use that reputation to actually privatize this order flow. So just assume at the moment, like in Cow, for example, as mentioned, the fee that the user has to pay, 70% goes to the protocol, 30% goes to the solver. If I'm the top solver and solve 50% of the order flow, and I know the order flow is, I do not know, originating from wallet X, I could go to the wallet and say like, hey, if you come directly to me and directly use my RFQ API, for example, then we could just go around, for example, in this case, Cow, we could save the 70% of the fee that we have to give to Cow otherwise and maybe split that margin or whatever. So there's a huge tendency, and I'm not sure if you would call that a second order effect, but from the solver markets not being sustainable, that it forces or like incentivizes solvers to actually aim for private order flow and actually take away order flow out of those markets and protocols and privatize it via private RFQs. And you will see when you just scan the top 10 teams on Cow and otherwhere, you will see that most of them provide own swap APIs and try to do that already, or are doing that already with more or less success. Yeah, and last point that I want to make is definitely liquidity alpha is driving the competition. And with that, I want to kind of revert back a little bit to that point I made in the beginning, that in the beginning, or the goal for DEX-based protocols or for solver-based protocols like DEXs or cross-chain was to introduce solver competition as a way to basically build economic trust and have a fair market actually competing for the best user outcome. And that's actually at the moment not the case. There's more alpha sources than that. We would call alpha in the sense of like, hey, advantages that certain solvers have that others don't. But liquidity seems at the moment definitely to be the most driving factor, and actually being absolutely prohibitive to like a really fair market. Because we have seen in Cow, for example, that with access to private liquidity and not having to tap into on-chain liquidity, you will be able to perform way better and way more cost effective and with way less risk than somebody who has less liquidity or has to tap into on-chain liquidity. So in top solvers, we have seen that across Cow and across have actually access to one or double-digit amounts of millions of USD in inventory or private RFQ volume, and that's something that increases, I would say, decentralization in that market. Yeah, so kind of that's what I wanted to share here, and I hope it kind of created a little bit more broader view. I'm not sure if you were aware of some of the issues mentioned here, but definitely now the more interesting question is like, how can we actually counter that, and what's the way forward in terms of making those markets actually fair and ensuring actually that we don't end up with monopolies or like a very little amount of oligopolies in the near term or midterm. Yeah, and with that, I give it back.
Thank you for that awesome presentation. Everyone can hear me, right? This is Anoma Day, in case the stream glitched earlier. If you're not looking for Anoma Day, you were in the wrong place. Thank you, Alex. We have a bunch of questions, some of them from the community over the internet, some of them potentially from the live audience. I'll start with the internet, then move to the live audience and alternate. We have about 10 minutes for questions here. Does that sound good?
Sounds great.
Great, and you can hear me. Awesome. One thing works. I don't know, I'm just speaking into this abstraction. Okay, so Singh Sahab, hope I didn't mispronounce that, from the community asks, quote, how do protocols ensure that solvers do not form monopolies or cartels? Are there mechanisms in place to promote fair participation and prevent solver centralization? Kind of relevant to your last slide.
Yeah, it's a very good question. I mean, I'm not an expert in all of the protocols, obviously, and it's a changing landscape and stuff like this. But I would generally say, obviously, there's two competing factors here. And I didn't mention that one here. So obviously, the protocols have an interest in being competitive. That's one dimension of it. So when I'm Cow or across, I compete with other bridges, or I compete with other DEX protocols, solve-based or even non-solver-based. And that creates a certain pressure on me. That means leads usually to a prioritization of user welfare. User welfare means usually price and speed of filling the orders or intents. So that's one dimension, and that's a very hard dimension. For example, when I showed across in the beginning, the reason why across, I guess would also love to see that more of the volume is actually filled by other solvers and not half of it has to be filled by themselves. But there's on the other side the market pressure that tells them, hey, I don't know, Circle CCTP does USDC bridging for almost zero in fees. That's our market niveau, and we can't go way below that. And if the solvers won't take it at that price point, then we have to see. But that's one dimension of it. But the other dimension is definitely when you look in, for example, into the governance forums of Cow or in the forums of Across, you will definitely see that the teams are taking a lot of initiative to kind of understand better where does the decentralization come from? How can we actually counter it? There was some, for example, in Cow, some proposals to ban pennying and stuff like this. That's also where the bond in Cow comes in. The bond is usually because there's a lot of stuff like for example, those I would say social consensus. You build a cartel or whatever that you can't kind of verify on chain, or that's something that's happening totally off chain. That's why for such cases there is a kind of court and a kind of bond that can actually be slashed in case of certain misbehavior. And this misbehavior is defined pretty vaguely, but goes in the direction of forming price cartels, doing pennying and other types of activities that actually indicate malicious behavior instead of basically bidding your true value.
I guess a follow-up from me is just, could it not be the case that the goals of promoting user welfare and promoting solver decentralization are sometimes actually in tension or opposed to each other? Like, there are a lot of classic results in game theory that talk about the price of contention or the price of anarchy, and just fundamentally to talk about the physical costs, as you mentioned in a slide. You know, if there are 50 solvers who we want to be supported by a protocol in some sense, they have actual physical hardware costs, they have operational costs. You know, you lose some economy of scale when you want decentralization like this, right? And fundamentally, those costs have to be passed on to users for the protocol to be sustainable, right? So isn't there this kind of, like, in theory, an efficient monopolist that only extracted a little bit could actually promote user welfare better than a bunch of distributed solvers, right?
Yes, it is.
Or not?
A very good question. Very good question. But I mean, that's the same risk. I mean, I didn't mention that here, but you can actually look at it. We saw in the beginning the trade or transaction supply chain, and it's actually not that unsimilar to proposal builder or the builder centralization. Exactly the same, you know. And I think the only way to counter it is like, or you can look at it two ways. First way is, I think you need to go after the liquidity problem. That means after private liquidity being actually the one that dominates everything. And how would you do that? You would do that ideally with making, you could do a lot of, to do that, you could either enforce something like, I would not know, something like a solver net. So similar to a builder net that's proposed to do the, to basically solve the builder centralization. You could imagine the same as the solver net, where basically all order flow can be seen by all solvers, because there's also, we didn't talk a lot about all the I would say unnecessary costs that are right now involved in solving. You know, when we kind of want to onboard one new protocol, we have to implement a new auction system. We have to kind of look at a new reference implementation, maybe in TypeScript or whatever. So there's a lot of costs that are basically unnecessary if a lot of the interfaces would be shared and would be common. So I think the way to counter that, like a centralized platform actor that has a lot of economic advantages and economics of scale, is you have to make sure all order flow can be seen by everybody, because then you have the maximum optimization band and can actually provide the maximum surplus in terms of outcome for the user. So I think the only, you could, I'm German, so I do not really know how that translates into English, but we have a proverb saying something like, you have to escape by running to the front, you know. So I think the actually right way out of that is actually to opt for more decentralization, actually ensuring that there's basically a global auction market, you know, and that is being used, and that will be superior. And then there will not be a lot of advantages anymore in privatizing order flow and stuff like this.
All right, single global standardized auction. That couldn't possibly have anything to do with Anoma. We have time for only one more question, I think. So let's try for one from the live audience. Michael.
Thanks for the talk. My question was related to, and you partially gave an answer already, to how you could make integration easier for new teams. You told that cow swap and the complexity of the system makes it sometimes easier to understand the penalties, and are there other things that would make life easier and lower the cost for people integrating?
Yes, so there's multiple things here. So I mentioned those 5 steps in the beginning, or process steps on solving. There was the first step, which is like sourcing liquidity. So actually one of the biggest things, I think, where a lot of at least DEX solving teams spend energy is maintaining this liquidity index. It means understanding, is there a new DEX out there? How do I read the pools there? How do I understand how I can query price curves and stuff like this? I think a first meaningful step would be to kind of create a public shared liquidity index that actually is maintained by all the protocol teams. Actually, Propellerheads has started an initiative in this area already with their Tyco SDK, but I think there has to happen more in terms of basically creating those shared interfaces. On the cross-chain side, there's another interesting thing to look at, and that's the open intents framework, or even ERC 7683 as like a cross-chain intent standard, where the community starts now to define those interfaces that actually ensure when I have those interfaces implemented, actually as a solver, I can switch quite easily to those protocols and solve for them. It doesn't solve yet the problem of like, hey, ideally we would like, for example, to merge orders, you know? So we would like to, for example, win an order in CowSwap and win an order in across at the same time and actually settle them together and see, can we do cost optimization and arbitrage actually over them together to maximize the user surplus. But that's a little bit far away. But we see already that standardization in the cross-chain intent space at least is happening. I'm not so sure about the non-cross-chain side of things, but there's definitely way more work there to do for sure.
All right. Thank you very much. Let's give it up again.